We survived the month of September, which is historically the worst performing month for the S&P 500. Now we enter the month of October, which is historically the most volatile month. It doesn't necessarily lean one way or the other in terms of performance, but it could give us some opportunities to buy the dip on many stocks we like. As such, in today's video, we're going to take a look at 4 stocks that I believe are cheap at today's valuations and to have high on your watch list. But before we dive into each of these, do me a huge favor. Show your appreciation by clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 4 top stocks to buy for the month of October. But before we do, let's recap some of those picks that we had for the month of September. And I hope a bunch of you jumped in to one of these picks. To recap, in the month of September, the 4 stocks we covered were ASML, CEG, Alphabet, as well as Alexandria Real Estate. Looking here at this chart, look at the performance over the past month. Shares of CEG, which is Constellation Energy, soared more than 60% just in the past 30 days. I can't say I saw that much growth coming, but holy cow, that was amazing. Shares of Alphabet have climbed 6%, and ASML and Alexandria dipped slightly. But holy smokes, I had a number of you that had messaged me within my Stock Investors Edge Discord saying you did in fact jump into shares of CEG, and good for you. And if you are not yet a part of our Stock Investors Edge Discord community, definitely sign up. There's a link down in the description below. It's completely free. That is the easiest and fastest way to get a hold of not only myself, but as well as my team. All right, with that being said, let's jump into our 4 stocks for the month of October, beginning with October stock number 1, which is going to be Adobe, stock ticker ADBE. When it comes to Adobe, there's investors that are on both sides of the aisle. They're still trying to figure out how AI is going to impact the company. On one side of the aisle, there's many investors out there saying that AI is going to essentially replace a lot of what Adobe does. And then on the other side of the aisle, there's many investors out there that says this is going to only further impact and make Adobe that much more efficient, that much more powerful. However, when you look at the results, and that's the best thing that you can do as an investor, the results continue to climb higher. Higher sales, higher RPOs, which are all positive signs for a company like Adobe. When looking at Adobe, they operate out of the sector of information technology. They have a market cap of $223 billion, and over the past 12 months, shares are down 2%. Clearly, shares of Adobe are underperforming the greater stock market by a wide margin, and it is very clear that investors are grappling with the idea, the impact that AI is going to have on them. But if you are a believer that AI is going to have a positive impact on Adobe moving forward, then this could be a great opportunity, a great valuation to jump in to a company like Adobe. Let's take a look at valuation right now. For starters, the company has a strong balance sheet with a current ratio of 1.1 and a quick ratio of 0.97. EBITDA margins ended 2023 at 40%, the second highest in the history of the company. And when looking at some valuation, we could see that the company has a forward PE multiple of 25.1. This is well below the company's historical 5-year average of 31.8 times. Looking at another valuation metric, EV to EBITDA is a favorite of mine. The company currently trades at 29.4. Again, well below their 5-year average of 34.2. This is the lowest multiple since 2022, and before that, 2016, which is saying something. Analysts are also high on the stock, giving the company a buy rating with a 12-month price target of $621, implying 23% upside from current levels. And that leads us to October stock number 2, which is going to be Amazon, stock ticker AMZN. Amazon shouldn't be much of a surprise. It's a company I've talked about a number of different occasions, and it continues to be a favorite of mine, especially amongst the Mag 7 companies. It is one of the cheapest Mag 7 companies out there. And by now, if you've watched a number of my videos, you know that I like to invest in companies that have multiple revenue streams. And when we're talking about Amazon, it's just not e-commerce. It's not just cloud. They have AI, they have subscriptions, and the list goes on. Amazon operates out of the consumer discretionary sector. They currently have a market cap of nearly $2 trillion, and over the past 12 months, shares are up 47%. That should be telling you something to the fact that I still like a company that is trading 40% higher than it was just 12 months ago. And that should also tell you that as an investor, don't get caught up in stocks being at 52-week highs. Focus more on valuation because it isn't out of the ordinary to see a company at a new 52-week high. But if you look back 6 months prior, today's price could actually be cheaper than it was 6 months ago. Taking a look at valuation, for starters, the company has a strong balance sheet with a current ratio at 1.1, a quick ratio at 0.88. The company has strong margins with EBITDA margins at 17.6%, the highest in the company's history. Continues to show they are firing on all cylinders. In terms of valuation, the company trades at a forward PE multiple of 32.5 times, well below their 5-year average of 52 times. And another valuation metric, EV to EBITDA, currently trading at 19 times flat, well below their 5-year historical average of 25.7. Again, this is the lowest multiple the company has ever seen outside of the 2022 crash we saw. Analysts are also high on the stock, giving the company a 12-month price target of $224 per share, implying 20% upside from current levels. And that leads us to October stock number 3, which is going to be PayPal Holdings, stock ticker PYPL. This one might be a little more controversial. In fact, it's a lot like Adobe. There's one set of investors that believe in the growth and the expansion that PayPal can have, especially as e-commerce continues to grow. But on the other end of the spectrum, there's many investors saying there's a lot more competition that's out there. Look at Google Pay, Apple Pay. You also have Amazon Pay and Alipay, and the list goes on. So when it comes to PayPal, I like to label them as a GARP trade, growth at a reasonable price. And we will be looking at that reasonable price here in a second. Taking a look at PayPal, they operate out of the financial sector. The company has a market cap of $81 billion, and over the past 12 months, shares are up 35%. 35% is fantastic. It's not quite as high as Amazon was, but again, Amazon has been a little bit more consistent. When we zoom out and we look at PayPal, PayPal went parabolic during the pandemic. And when we look at a 5-year chart, you're looking at a stock that is down more than 25%. However, even with more competition coming and growth trends are trending down, that is clear, valuation has been clearly punished. For starters, let's take a look at the balance sheet first. The company has a solid balance sheet with a current ratio at 1.2, a quick ratio at 1.2 as well. EBITDA margins are at 23%, the highest outside of the 2020 pandemic year. And in terms of valuation, the company trades at a PE multiple of 15.9. This is well below a market multiple, which is suggesting very little growth. This is also well below the company's 5-year average of 21.2 times. They trade with an EV to EBITDA of 11.6. That is well below, almost half of their 5-year average of 20 times. Whatever angle you look at valuations, this company is very cheap. And it's not like they aren't growing. Management and analysts are still expecting this company to have double-digit earnings growth moving forward. So if they can just hit that, this is a great entry point. When it comes to pricing, instead of showing you a price target, I want to show you just how cheap this company is. When we look at the fair value that Morningstar has on the stock, this is where they value the stock right now. This is what they believe the stock is worth right now. This isn't a price target. And you can see they value the stock at $104 per share, which is 35% above today's price. This is clearly the highest risk option on our list, but also a huge value upside play. And that leads us to October stock number 4, which is going to be Visa, stock ticker V. You've heard me talk about Visa a number of times, and I liked the company's valuation prior to the recent DOJ lawsuit that came about, which I believe is completely unwarranted. They are targeting the company's debit card network. This is the largest payment processor, but they are the largest due to the safety and the quality that they offer their customers. The trends are quite obvious. People today are using more credit cards than they are cash, and that's going to continue moving forward. We see that in the results from Visa. Volume results continue to climb. This benefits Visa and its close competitors. The company operates out of the financial sector. They currently have a market cap of $549 billion, and over the past 12 months, shares are up 20%. However, shares have pulled back more than 5% since the DOJ lawsuit. And even before that, again, as I mentioned, I liked the valuation then. This is a company that doesn't only operate at a high level with a great management team, they have huge margins, huge EBITDA margins, huge free cash flow margins. Let's first begin by taking a look at the company's balance sheet, which again is quite strong. The company has a current ratio of 1.4 and a quick ratio of 0.9. Those margins that I just mentioned, let's take a look at those right now. The company has insane EBITDA margins of 71%, the second highest in the company's history, and their free cash flow margins are at 54%. In terms of valuation, the company trades at a PE multiple of 24.2, well below their 5-year average of 28.6. They also have EV to EBITDA of 21.9, also well below their 5-year average of 25.3, the lowest multiple the company has seen since 2018. Analysts are also high on Visa shares, giving the company a 12-month price target of $315, implying 13.5% upside from current levels. So there we just looked at 4 high-quality companies trading at cheap valuations. PayPal is probably going to be the highest risk of all 4 that we looked at here today. But down in the comments section, let me know which of these 4 do you like the best? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.